What if I told you there's a type of loan in America where you could pay back more than 4 times what you borrowed, and it's completely legal? Not a scam, not some shady guy in an alley, a legitimate business with a storefront, probably within a few miles of where you live right now. I'm talking about payday loans, and the way they work is one of the most effective financial traps ever designed. Not because the people who use them are making bad choices, but because these loans are specifically engineered to look like a lifeline while functioning like quicksand. Let me show you exactly how this works. Say you're short on cash, your car breaks down, and the repair is $500. You don't have it, your credit cards are maxed. Your credit score isn't great, so a bank loan isn't happening, and you need that car to get to work. You pass one of those stores with the neon signs. Fast cash. Money when you need it. No credit check. You walk in. The process takes about 15 minutes. You show them a pay stub, write a post-dated check for $575, and they hand you $500 in cash. That extra $75 is the fee. You'll pay it back in 2 weeks when you get your next paycheck. $75 to borrow $500 for 2 weeks. That doesn't sound insane, right? It's not even that much more than an overdraft fee from your bank. Here's where things get interesting. And by interesting, I mean deeply troubling. That $75 fee? If you calculate it the same way banks calculate interest on mortgages or credit cards, it works out to an annual percentage rate of around 390%. Some states allow even higher. We're talking 400% or more. Now, the payday loan industry will tell you that's an unfair comparison. Nobody borrows for a whole year, they say. It's just 2 weeks. And technically, that's true. If you borrow $500, pay back $575 in 2 weeks, and never do it again, you paid $75. Not great, but not the end of the world. But here's what actually happens to most people. 2 weeks later, payday arrives. You now owe $575. But remember, you were already short on cash. That's why you needed the loan in the first place. Your regular bills haven't gone away. Rent is still due. Groceries still cost money. And now you're supposed to come up with $575 on top of everything else? So you do what the payday lender makes very, very easy. You roll it over. You pay just the $75 fee, and they extend the loan another 2 weeks. Now you still owe $500, but you've paid $75. In 2 more weeks, you'll owe another $75 just to keep the loan going. See where this is headed? After 8 weeks, you've paid $300 in fees. You still owe the original $500. After 16 weeks, you've paid $600 in fees. Still owe $500. The average payday loan borrower in America is in debt for about 5 months of the year. Some studies show closer to 200 days. During that time, they pay far more in fees than they ever borrowed in the first place. This isn't an accident. This is the business model. The payday loan industry makes most of its money not from people who borrow once and pay it back. They make it from people who get stuck in the cycle. Industry data shows that more than 80% of payday loans are rolled over or followed by another loan within 14 days. 80%. These companies aren't hoping you'll pay them back quickly. They're counting on you not being able to. So why is this legal? How can a business charge what amounts to 400% interest? The answer goes back to how these loans are classified. In most states, there are usury laws that cap interest rates. But payday loans often get around these laws by calling themselves something else. They're not charging interest. They're charging a fee. Different rules apply. Some states have cracked down. About 20 states have effectively banned payday lending or capped rates so low that the stores can't operate profitably. But in the other 30 states, it's the Wild West, and the stores know exactly where to set up shop. Research consistently shows payday lenders cluster in lower-income neighborhoods, near military bases, and in communities with fewer traditional banks. They're fishing where the fish are hungriest. Now, I want to be really clear about something. If you've ever used a payday loan, this video isn't about making you feel bad. When you're desperate and out of options, you do what you have to do. The problem isn't people making irrational choices. The problem is an industry designed to profit from desperation. But knowing how the trap works is the first step to avoiding it, or getting out of it if you're already there. Let's talk about alternatives. None of these are perfect, but almost all of them are better than a payday loan. First, If you have any credit cards with available balance, even a cash advance with its high fees is usually cheaper than a payday loan. Yes, cash advances are expensive. The interest rate might be 25 or 30%, but that's annually. Compare that to 390%. Second, ask your employer for an advance on your paycheck. This feels awkward, I know. But many employers will do this, especially if you've been there a while and have a good track record. Some companies now offer this as a regular benefit through apps. Third, look for a payday alternative loan from a credit union. These are specifically designed to compete with payday lenders. Credit unions are required to cap the interest on these loans at 28% annually. The maximum loan amount and repayment terms are regulated too. You usually need to be a credit union member, but joining one is often easier than you'd think. Fourth, local assistance programs. Churches, community organizations, and nonprofits sometimes offer emergency assistance or interest-free loans. It takes more effort to find these, but they exist. Fifth, negotiate with whoever you owe money to. If you need the cash because you can't make rent or a car payment, call them directly. Many landlords and lenders would rather work out a payment plan than deal with the hassle of late fees and collections. The worst they can say is no. Sixth, borrow from family or friends if that's an option. Yes, this can be uncomfortable, but uncomfortable beats trapped in a debt cycle for 6 months. Just be clear about repayment terms and actually follow through. Now, what if you're already in a payday loan cycle right now? Step 1 is to stop the bleeding. If you're rolling the loan over every 2 weeks, every fee payment is money that could go toward actually paying it off. You need a plan to pay the principal, not just the fees. Some states require payday lenders to offer extended payment plans. Check your state's rules. The lender probably won't volunteer this information, but they may be legally required to give you more time if you ask. If you have multiple payday loans, which is disturbingly common, focus on one at a time. Some people try to borrow from one to pay another. That's like digging a second hole to fill the first one. It doesn't work. Consider talking to a nonprofit credit counselor, not a debt settlement company. Those often charge their own hefty fees. But an actual nonprofit credit counseling agency can help you negotiate with lenders and build a realistic repayment plan. And here's something that might surprise you. If a payday lender is threatening you, know your rights. They cannot have you arrested. They cannot take your property without a court order. They can be aggressive, but there are limits to what they're legally allowed to do. The payday loan industry makes about $9 billion a year in fees. That money comes overwhelmingly from people who are already struggling. It flows from some of the poorest neighborhoods in America into the pockets of an industry that has spent millions lobbying to keep regulations weak. Understanding how this works doesn't mean you'll never face a financial emergency. Life happens. Cars break down. Medical bills show up. Unexpected expenses don't care about your budget. But now you know what you're walking into if you see that neon sign. You know the 2-week loan is designed to become a 5-month loan. You know the small fee adds up to more than you borrowed. And you know there are almost always better options, even when they're harder to find. The trap only works if you don't see it coming. If this helped you understand something that felt confusing or overwhelming, that's exactly why this channel exists. We break down financial topics without the jargon and without the judgment. If that sounds useful, subscribe to Like Your 5. We'll keep explaining stuff that matters in a way that actually makes sense.